Thank you. Welcome to the New York City Retirement Systems Common Investment Meeting for June 19th, 2019. We're going to start by convening each of the boards. And let's start with Fire. Mr. Dunn.
Good morning, Mr. Adler. How are you?
Good morning.
Today?
I'm well. How are you, Mr. Dunn?
I'm doing ducky. For the fire department, for the Mayor de Blasio.
Cynthia Collins, designee for Mayor Bill de Blasio.
And for Controller Scott Stringer.
Jennifer Konovitz.
For Commissioner of Finance, Jacques Giha.
Phil Dukes.
For the UFA, Mr. Gerard Fitzgerald.
Gerard Fitzgerald, proxy.
Can you say it into the mic and louder? I'm not sure our transcription is.
Oh, I'm sorry about that. For the UFA, that was Gerard Fitzgerald, and Mr. Edward Brown has his proxy. For the UFA, Mr. Leroy McGinnis.
John Kelly has Leroy McGinnis as proxy.
Mr. Edward Brown.
Here.
Mr. John Kelly.
Present.
For the UFOA, Pete DeVita, missed you. John? Sorry.
John Young, proxy for Pete DeVita.
Okay, for the UFOA, Mr. Jack Kelty.
Liam Guilfoyle with Jack's proxy.
Liam is here.
Here.
And Paul Mannix.
Here.
Fire Commissioner Dan Nigro, represented by.
Terrell Brown for Dan Nigro.
We have a quorum.
Thank you, Pat. Next, let's do the Police Pension Fund. Get Mr. Holleran.
Good morning. Representing the PBA,
PBA Joe Alejandro.
Pat Hendry.
Juan Zubizarreta.
DEA,
Michael Palladino.
SBA,
Anthony Bradley, designee Ed Mullins, SBA.
LBA,
Lou Turco.
CEA,
Chris Monahan, designee Roy Richter, CEA.
representing the Mayor,
Shuman Ray, representing Mayor Bill de Blasio.
Commissioner of Finance,
Phil Dukes.
Comptroller,
John Dorsett, designee for Control Scott Stringer.
and the Police Commissioner.
Stephanie Zimberg, designee for Police Commissioner O'Neill.
We have a quorum.
Thank you, Kevin. Next, let's do the teachers. Ms. Riley?
John Adler,
I'm here.
Thomas Brown. Here. Natalie Green-Giles.
Here.
David Gazansky.
Present.
Lindsay Oates.
Here.
Deborah Penny.
Here.
Susanna Vickers.
John Dorsett, designee for Control Scott Stringer.
We have a quorum.
Thank you, Patricia. And for NYSERS, Ms. Winery. John Adler, representing Mayor Bill de Blasio.
Controller's Office,
David Jetter, representing Controller Scott Stringer.
Public Advocate's Office, Borough President Manhattan,
Aldrin Bonilla, designee for Manhattan Borough President Gail A. Brewer.
Borough President Brooklyn,
Did you get that? I heard it. Okay. It's okay, he got it.
okay.
Thanks.
Borough President Bronx, Borough President Queens,
Sharon Lee, representing Queensborough President Melinda Katz.
Borough President Staten Island,
Isaac Gordetsky for James Otto.
International Brotherhood of Teamsters,
Lawrence Bosley and Ruben Torres for Greg Floyd.
Transport Workers Union,
Dave Katzman for TWU Local 100 President Tony Otano.
and District Council 37.
On behalf of Executive Director Henry
We have a quorum.
Thank you, Melanie. And BRRS, Daniel?
Good morning, John. We do not have a quorum today. We'll vote on that tonight, our meeting.
Thank you. Okay, so all the boards are here and accounted for, and I will turn it over to Chief Investment Officer Alex Donier for our quarterly report.
Thanks, John. Good morning, everyone. Today we will begin with a market overview, since it is a quarterly sim by Michael Haddad. I will do the performance overview for the quarter and followed by our risk report from our Chief Risk Officer, Miles Draycott. So we'll begin with Michael Haddad.
Great.
Good morning.
Good morning.
As Alex said, I'm going to talk about financial markets in Q1. I'm going to divide that into three sections. as per the mandate, Q1 financial markets. And then I'm going to talk a little bit about current themes in the markets. And lastly, I'm going to talk about your portfolios, so rebalancing activity that took place in Q1, as well as your actual asset allocation versus your targets. So let's just kick off quickly into Q1. This is the usual slide on this. I would draw your attention to the third column, which shows the returns for the various public asset classes in your portfolio. And a couple takeaways. If you focus on the first three rows, the returns in equity markets were absolutely outstanding in the first quarter. Almost double digits across the board, across U.S. and international. And as a reminder, you could almost reverse the sign for what we had in Q4. So everything was down in Q4, everything bounced back in Q1. The other takeaway is that on all time horizons listed here, Q1, fiscal year, 3-year, 5-year, U.S. equities continue to outperform international equities and emerging market equities. On fixed income markets in Q1, another, again, outstanding returns in Q1. Fixed income benefited from both a drop in yields and a tightening of spreads. So 30-year yields were down 18 basis points in the quarter. Investment grade spreads tightened by 30-something, high yield by 130-something, resulting in very strong performance in fixed income asset classes. One other takeaway from here is, again, the shifting correlations. In Q4, as a reminder, equities were down, fixed income rallied, negative correlation in effect. In Q1, a positive correlation. Both asset classes had positive returns. So what happened in Q1? What changed between Q1 and Q4? So I would argue two things. First, reduced global growth concerns, a major shift in Q1. So it seems like ancient history because we get tweets every day. But as a reminder, the government shutdown started on December 22nd. It ended on January 25th. There was a tremendous amount of uncertainty around that government shutdown. How long it was going to last? What kind of implications for the economy? When were we going to get statistics again? So that ended at the end of January. The second thing that happened is financial conditions were easing. My next slide is on that, so I'm going to save comments there. The other thing that was different in Q1 is there was optimism on U.S.-China trade negotiations. Again, as a reminder, in December of 18, there was the G20 in Buenos Aires. One of the outcomes of that is Trump and Xi had agreed to not increase tariffs and to negotiate in good faith, or whatever you want to call it. And that was taking place during Q1. Chinese equity markets were up almost 25% in the quarter, and the Chinese currency rallied in Q1 as well. In my next part, when I talk about current concerns, those are going to be the opposite. The second thing that changed was the Fed. So the Fed had a significant pivot away from raising rates to a bias towards lowering rates in Q1, and it came in three different arenas. It came on the policy rate, so the Fed funds rate, the thing they mess with. So in Q4, they were talking about being far away from neutral, about more tightening, and then that gradually diminished into Q1, such that they were talking about being on hold and maybe even potentially having to easing. Secondly, at the March FOMC meeting, they announced the end of quantitative tightening, and that surprised markets in a few different ways. The announcement came earlier than expected. They're ending quantitative tightening earlier than expected, keeping the balance sheet larger than what markets had previously thought. And lastly, on inflation strategy. So the Fed, the inflation has undershot the Fed's target for years, and the Fed is undergoing some serious consideration on what to do about that, which could result in a meaningful regime shift as how the Fed thinks about monetary policy and how they implement it. Again, more to come on that one later. So financial conditions. As a reminder, financial conditions are basically four different market inputs: the yield on the 10-year Treasury, a broad dollar index, a broad equity index, and investment grade spreads. And the takeaway from this graph in Q4 is highlighted in red, Q1 is highlighted in green. When financial conditions tighten, it leads to slower growth. When financial conditions ease, it leads to stronger growth. And into Q4, we can see a meaningful tightening of financial conditions. In Q1, they loosened up quite a bit. So this shift in financial conditions had a lot to do with the very positive returns in Q1. This slide highlights the change in expectations of Fed policy. So let me try and walk you through the top half of the slide first. The blue bars signify the amount of tightenings expected in markets through 2020. And if you can't quite read the scale, but there were about 3 tightenings expected by the end of 2020 throughout the quarter. And you can see as those blue bars were declining, the markets were expecting less tightening. And you shift over to Q1, and they're actually expecting easings. By the end of Q1, there were almost 2 easings priced into markets, and that had a meaningful change in sentiment in markets, and as well as a big contributor to the positive returns in both fixed income and equities in Q1. The gold bars, yeah. Yes. So each tightening, each ease is considered 25 basis points. That's what those bars imply. The gold bars signify when there were FOMC meetings, and those were meaningful changes in the markets. And as I mentioned at the March FOMC meetings when they announced the end of quantitative tightening. As a reminder, I just showed you asset class returns in Q4 versus Q1, and you can see basically a sign change in each one of those. And it's my 2 cents that one of the big drivers was the change in market expectations of Fed policy. Contributing to the Fed's dovish pivot is this undershooting of inflation. So what I've shown here in the horizontal line that goes across, that's their 2% inflation target. The white line is what's called the personal consumptions expenditure inflation measure. It's similar to CPI. It has a little difference in components, but this is what the Fed uses. And you can see over the past 5 years, while we've been in a strong economy, positive fiscal stimulus, that we've barely pierced 2% inflation. So this is causing consternation at the Fed, more so than in the past several decades, and we're on the cusp of, I would argue, a regime shift in how monetary policy is formulated and how it's implemented. And without getting into too much minutia on that, what it means is the Fed's probably going to be easier than they would be otherwise in their attempts to try and reach 2% inflation. That kind of wraps up my 2 cents on Q4. Before I go into current market themes, let me pause for any questions or comments on Q1.
Any questions for Mike? Good to go.
Current themes. I've listed 3. There's a host of them, but I'm going to talk about 3 different ones. First one is U.S. and trade policy and tariffs. Second, more on the Fed. And third, equity earnings and valuations. So on trade negotiations. So in contrast to Q1, trade negotiations have deteriorated. As a reminder, Trump increased the existing tariffs from 10 to 25 on $200 billion of imports. China retaliated with tariffs on about 70 billion of imports to China. What remains is a threat to establish tariffs on the remaining 300 billion of Chinese imports. There's a G20 meeting at the end of the month. Trump and Xi are expected to meet. We got a tweet yesterday there was a tweet yesterday by the president saying it was going to be an extended meeting, and that added to the bullishness in equity markets yesterday. So that is a major source of uncertainty facing markets. In addition, the U.S.-Europe auto tariff remains a point of contention. And what I tried to show you in this table is just kind of the GDP and inflation math from an increase in tariffs. So the first row is when the U.S. increased tariffs from 10 to 25%, and it's a downward reduction in estimated growth and an upward vector in inflation. The additional 25% does more of the same. And if we implement an auto tariff, that's going to again do more of the same. And it's just to highlight the slight impact that these tariffs have when you think about GDP and inflation. But most importantly, what it does is the different financial linkages that fall from this, and that I tried to capture in the bullets on the bottom, and that just increases economic uncertainty. And when corporations are in times of uncertainty, what do? They tend to tighten their belts a little bit. It's going to be less spending on employment, less spending on CapEx, lower growth, just outcomes that I think all of us, all market participants want to avoid. And secondly, and what's really challenging is corporations are being forced to reevaluate their supply chains. Over the past, 3 or 4 decades, as China has opened up to the Western world, the global supply chains have really become intertwined between countries. And if those have to get unwound and reestablished elsewhere, it's going to lead to, slower spending, lower growth, and just, it might be the tipping point that puts the economy into recession. The Fed. The Fed is having a meeting today. Expectations are there's a small probability of a rate cut built into the market, but most market participants don't think they'll ease today. We find out at 2 o'clock. What the markets do expect is language from the Fed that kind of outlines downside risk to growth and concern about missing the inflation target, and that message will lay the groundwork for potential easings going forward. What's also priced into markets as of this morning is a 25 basis point cut is fully priced for the July meeting. There's almost 2+ cuts priced for all of 2019, and an additional cut priced in 2020. Which kind of leads me to the second part of this slide. So when we think about easing regimes, which is bond market vernacular for lowering rates, there's three different ways to think about what could be this lowering rates regime by the Fed. The first one is the standard, we finally get the recession, that the cycle has ended, and that is the standard. The Fed lowers rates to try and stimulate the economy. And when you think about that and if you do look at previous examples when this happens, the equity market goes down for a couple of years in that environment. The funds rate probably goes to zero, all yields probably go lower, and a steepening curve, and the dollar's likely to weaken in that environment. The second possible easing regime is what we call an insurance easing, and that is a small number of eases to sustain the recovery. That we don't go into, the economy does not go into a recession. It slows, but then it steadies out and resumes its growth. And there's some examples in the 90s when the Fed did that, and in 95 they eased almost 3 times after tightening meaningfully. And you're going to hear more from Miles in some stress test scenarios when he goes through this. The third one that I mentioned earlier would be a regime shift in the Fed, and that is to somehow compensate with the use of monetary policy for this undershooting of inflation. There's a couple ways they can get about that. Average inflation targeting is one of the ways, and what that implies, if you think back to that previous slide, if they undershot inflation for a number of years, they need to overshoot inflation to catch up for what they missed. And again, without getting into the academic theory on that, what that means is that all things being equal, the Fed is going to have lower rates than they would have otherwise. That would be supportive for equity markets, I believe. It would lead to lower rates in the front end of the market, but probably higher rates in the back end of the bond market. Again, 3 very different regimes, 3 different impacts on markets and your portfolios. The last theme I wanted to talk about was U.S. equities, earnings, and valuations. A lot of stuff on this slide, so bear with me on this. So Q1 earnings, so that was the earnings released like from mid-April to the end of May. They largely were in line with expectations. But if you look at the table on the left-hand side, if you take your eyes to 2019 estimates, in the fourth quarter, earnings estimates for 2019 came down, and those are reflected in that 178 to 170. So even though Q1 earnings came in as expected, they came in at a lower level. So it's partially good news, but not necessarily all good news. Q2 earnings start in mid-July. What typically happens in earnings season is before they officially report, the companies who are going to miss earnings, they give a little guidance on that. And we got an important earnings warning last week, and that was by Broadcom. Broadcom is a semiconductor manufacturer. They're very active in phones, tablets, and computers. So it's a good early warning signal for what might be happening from the trade war. And they guided revenues down almost 8%. They cited geopolitical uncertainties. They cited the tech war, if you will, with China. So if that's an early warning signal to what might be coming in the second quarter, that's going to signal downside risk to earnings in our mind. So I kind of highlighted that. So when we think about earnings for 19 and 20, there seems to be more downside risk than upside risk. And that's rising labor costs, tariff concerns, and just slowing the revenue and growth overall. Thirdly, equity buyback programs are slowing. As a reminder, in 2018, equity buybacks totaled almost $1 trillion, which was double the average if you average 15, 16, and 17. So equity buybacks were fueled by the tax cut for corporations. So that's now all that's all happened in 18. 2019 equity buybacks are trending at about a $600 billion pace. Still meaningful, but it's slowing from 2018. Which kind of begs the question, what's the appropriate PE multiple with these two strong opposing forces on the equity market? Downside earnings risk means lower equities, but if we have lower interest rates from the Fed, that argues for higher PE multiples. So the tables on the right are meant to be sensitivity analysis to show, if you take the top table and that red circle, so if consensus earnings for 19 is $170 a share, and we traded the 17 multiple, we're right around $28.90. You know, I think the S&P this morning is right around $29.25, so we're right in that neighborhood. But if there's downside risk to earnings, you know, you can see the sensitivity. If we trade at a lower multiple, you know, then we end up with a lower equity market, which then begs the question: what is the appropriate multiple? The multiple, it's not science. It's market psychology. What drives the multiple? I would argue three primary drivers are the level of earnings, the growth rate of earnings, and then the trajectory of those earnings, and then lastly, interest rates. So this chart goes back almost 14 years. This is the 1 year forward price earnings multiple. And what it shows you is that we're relatively expensive. It's not egregiously expensive. If I took this chart back to 2000, you would see in the dot-com bubble, that number was closer to 30. In hindsight, that was egregiously expensive. You know, on the other side, in the depths of the global financial crisis, which is captured on this chart, you can see the PE, the forward PE multiple was more around a little over 9. And that is just uniform, you know, at the time very, very cheap, inexpensive, and makes risk assets more attractive. So the takeaway from here, in my mind, is that the 1 year forward PE multiple is on the expensive side of history, although not egregiously expensive. Let me pause there for any questions or comments on themes before I go into asset allocation.
Any questions for Mike? You have a question? Okay, keep going.
So this part is a portfolio update. And the first one is the rebalancing activity that we took on behalf of your portfolios in Q1. And we were active. We did three things. We extended duration in your treasury portfolio. And I have some metrics on that on the last slide. We rebalanced your developed international equity exposure back up to target. With the sell-off in the fourth quarter, your portfolios fell below target, so we rebalanced that back up to target. And we increased the underweight in investment-grade credit. The concerns we have going forward, you know, I've talked a little bit about the equities, why we still think in U.S. equities there's downside risks to them, including late cycle dynamics. Some of these same thoughts apply to international EM equities, with the exception of valuations. EM equities are on the historically cheap side, less expensive, and the same can be said for international equities. The other concern is with the, again, the Treasury market. So different parts of the yield curve have inverted. The lowest yielding part of the yield curve is the 5-year, and that is historically an unusual phenomena. So as the market is trying to price in a Fed easing regime, it's not quite sure which of those 3 regimes we're going to enter. So it's going to cause some changes in not only the level of yields, but the slope of the yield curve. So we're on board for the easing campaign, for the potential for eases, and we've extended duration accordingly to try and get your portfolios more positioned for that. Credit spreads, we still think there's widening risk. If there's one place of financial vulnerability in the capital markets, it's credit, and it's probably more so investment grade than high yield. Corporations have levered up both for returning money to shareholders and for expansion. And if there's a source of concern, it's in the investment grade market. We're underweight mortgages because the Fed is going to continue to lower their holdings of mortgages on their balance sheet and deploy that capital into Treasury. So we want to remain underweight mortgages as well. So specific to your portfolios, these are the bubble charts you're used to seeing. We're going to show these in 3 different ways. This is your growth portfolio. We're going to show the inflation protection portfolios as well as the deflation protection portfolios. As a reminder, what's here, the gray bars are the size of the rebalancing ranges that each board has approved, and the bubble shows you where you are, where each system is relative to their policy target. The red arrows mean that we have a negative bias towards that asset class. The green arrow is a positive bias towards that asset class. U.S. equities, each system is underweight, anywhere from 2 to 3% depending on the system. We have positive biases in both EAFE equities and emerging markets, but we're right on target. As you're all aware, there's been quite a bit of volatility in all equity markets, and so we're staying around target so we can have flexibility with that. Everything else is roughly in line with your targets, with the exception of high yield. As a reminder, there were 3 stages to the high yield implementation program, and when stage 3 gets implemented, those high yield bubbles will be right back on your targets. In your inflation protection parts of your portfolio, there's no tactical tilts in place. We're roughly right on the targets. In the deflation part of the section of your portfolio, we are overweight treasuries, and as I said, we're underweight mortgages and underweight credit. And in mortgages and credit, the rebalancing ranges are quite small, and we're at or near the maximum on those. And in previous discussions on this, we've really talked about the duration of the Treasury portfolio. And while we're overweight, we had been underweight your duration target for quite a time. And as I mentioned, we did some extension trades in the first quarter that moved that inflation, the duration target closer to what your asset allocation calls for. And I'm going to try and explain the duration in a different format today, so if you can just bear with me. So 4 lines on this slide. The original duration, the first row, this was the duration of your core bond portfolio, so treasuries, mortgages, and investment grade credit, where it was at the start of middle of 16 when we agreed upon and started implementation of the duration. So that's the original target. So we'll take police as an example because it's in the middle of the slide. So that original duration was 6.51 back in the fall of 16. When you calculate the changes to the core bond portfolio and the changes to duration, that would push your duration target out to 11.54. So that's where we needed to get to implement it. And as you know, there was a long plan to do that and to do it over time. And the last 2 rows show you where that duration target was at the end of December of 18, and then again where that was at the end of March of 19. So again, using police as an example, at the end of 18, we were near 80% of your target. At the end of 19, yours actually went down a little bit, but that has to do with how we calculated the component of your treasuries, and we used an offset to what the underweight was in equities. So it's just kind of how we keep track of it. If we used we use teachers for an example, which showed a larger extension. You can see that you went from 55% of your target to 71% of your target. And where we stand at the end of Q1 is you can see that those percentages are all meaningfully higher than where we were at the end of December of 18.
I have a question about that, Mike. What are the percentages refer to, the difference between the original and the new? Because 10.12 is not 71% of 11.76.
So if you do the difference between 11.76 and 6.19,
Yeah, okay.
that's what 5 and change. And we're at 10.12. So if you take that, how much has been accomplished versus what we got to? That's the
Thank you.
arithmetic on that.
And Mike, so can you kind of bottom line, the impact of this slide? So we've been kind of, doing this slowly over the past couple of years. We're not at 100%, and that means what for our portfolios?
That means you are not at the duration target that was agreed upon at the strategic asset allocation. For teachers, police, and fire, on the Treasury sleeve, that was 30-year maturities, which is an 18 duration. That's one component of that portfolio. For NYSERS and BRRRRs at a lower duration. So it means you don't have the duration, the complete duration exposure that was called for in the strategic asset allocation.
That's been a good thing because interest rates are so low.
It was a good thing until about November when interest rates started headed lower again. So we didn't catch that exact turn, but we got it at a much better rates than where we are now. And the other thing I will say, as the rebalancing committee, we have a little bit of delegated authority on where to position the duration part of your portfolio, and there's a big debate in markets where one should be on the Treasury curve, and it's between 10s and 30s. And the simple way to think about that is in a lowering yield environment. If yields move in a uniform fashion, you want the longest duration possible because that has the highest riskiness to any change in interest rates. But at the same time, if the yield curve is steepening, what that means is that the 10-year is going down at a faster pace than the 30-year. It's the ratio between those two versus the ratio of the riskiness of each one of those. So with the three systems who have the 18 duration on their Treasury portfolio, is in our esteemed opinion that you're better off in 10s than in 30s in this environment for a lot of the reasons that I cited. And that has to do with the Fed lowering rates. They're trying to boost inflation. If you're trying to boost inflation, that's not good for 30 years, all things being equal. So we have extended durations about as far as we're comfortable doing at this point. So in terms of the portfolios, if we had done it earlier, it would have benefited the returns of the portfolios better. But if we had done nothing, the returns would have been worse than the active decisions that we made on behalf of the portfolios.
Any other questions on this slide? For Mike? Okay.
Thank you, Mike. And now I will go back and step through performance for the first quarter. So beginning with our AUM chart, you see our AUM as of the first quarter is now above, on an aggregate basis, 200 billion. So back above 200 billion, where we were the last time in September of 2018. And you see the AUM by system. Looking at overall performance for the portfolio in the quarter, you'll see that performance ranged from 7.11% for NYSERS to 8.17% for BRRRRs. Again, a very strong quarter, as you heard from Mike in his market review. That being said, we were still slightly behind or lagging the index, which you see our index is a 65, 35, 65 index, meaning 65% equities and 35% the Barclays Ag. And we trailed that for the quarter, primarily because of our exposure on the equities front. And by that I mean we are underweight U.S. equities, as you heard from Mike when he went through asset allocation, as you know. And it's a quarter where U.S. equities were up 14%. So being slightly underweight U.S. equities led to an underperformance versus the index in the quarter. That being said, on the fixed income portfolio side, just looking at that part of the portfolio versus the fixed income or the Barclays Ag part of the index, we did outperform, given that the duration of the systems portfolio was longer than that of the Barclays Ag, but net slightly behind the index for the quarter. You'll see as well performance for the fiscal year to date through March and the 1-year trailing. I would note there that we are below the 7% assumed rate of return for those 2 periods, but looking at the longer term, the 3-year trailing, we are ahead of the 7% rate of return, assumed rate of return, and also exceeding the performance of large pension plans as measured by Tux. And as my reminder always, the Tux data is gross of fees. Now, let's look at performance by systems. And now here again, we're looking at the performance across each system versus each system's respective custom benchmark. And you will see the biggest takeaway here is on the far right-hand side, which is that the systems are all beating their custom benchmarks for the quarter. And the horizontal line represents the 7% assumed rate of return for the quarter, which the systems also handily beat. Now let's decompose that and look at the components of those returns for the quarter versus the custom benchmarks. And you'll see that most of that return and outperformance, the excess, is coming from manager value add, which is certainly what we are looking for. So that is positive. But if you look at the middle column, just want to make a small point that there is some drag to overall excess returns from asset allocation, and that's 2 components. Again, it's U.S. equities tilt, so our tilt in U.S. equities, meaning being underweight to U.S. equities, hurt in a quarter where equities were up. U.S. equities were up 14%, and also on the fixed income side, you see that long duration bonds outperformed. So again, being slightly underweight our duration target, that last slide that Mike went through, it would be reflected here in the asset allocation. That would be where our tilts are interpreted, or reflected, I should say. Now let's take a look at performance by asset class, starting with U.S. equities, and you'll see that the performance, the excess here versus the benchmark range anywhere from a positive 27 basis points for BRRRRs to a negative 40 basis points for NYSERS. Just a couple of comments for each of the systems. Teachers was close to the benchmark, with Brown underperforming the most. For NYSERS and police, some of that underperformance is primarily research associates, and for police, DFA also contributed to some of that underperformance that you see. Fire was flat to the benchmark, and for BRRRR, some of that outperformance that you see is Wellington Midcap driving those results in the quarter. Here we have the EFI part of the portfolio. All systems outperformed in the benchmark, and it's primarily I would highlight Baillie Gifford being the manager that stands out, as they had a strong recovery in the first quarter of the year after a weak fourth quarter, if you recall, for Baillie. I would also mention Walter Scott as a standout for all systems, excluding teachers. Emerging markets. So emerging markets, you see 3 out of the 5 systems had slight underperformance in the quarter. Teachers and NYSERS actually outperformed. Again, that's Bailey Gifford in emerging markets, was a strong performer for teachers and NYSERS. Police and fire, you had DFA, parametric, and Acadian were some of the detractors in the portfolio, for the quarter. And again, as well, Burrs, Acadian, which is your sole active manager in emerging markets, is responsible for some of the underperformance there that you see in the quarter. Just one note that I like to make for teachers and NYSERS is that if you look at the performance of the standard MSCI EM benchmark, emerging manager best benchmark versus the custom benchmark did underperform the custom the custom benchmarks did underperform the MSCI EM benchmark for teachers and NYSERS in the quarter by about 375 basis points, and that has to do with very strong performance in the quarter from excluded countries in teachers and NYSERS benchmark, which is China and Russia. So just wanted to point that out. Again, just quickly on the fixed income portfolio, you will see that the systems underperformed the custom benchmarks in the quarter, once again driven by our underweight or being slightly below the target, duration target in the quarter. So in this environment of lower yields in the quarter, being longer duration outperformed. So the fixed income portfolio slightly underperformed in the quarter. Moving on to high yield. The high yield program had strong absolute returns. If you look at an aggregate, absolute returns were close to 7%, about 6.96%, but they still slightly underperformed versus the custom benchmark, versus the benchmark in the quarter. It's actually the strongest quarterly performance for the benchmark in almost 10 years. As you'll recall, in the high yield portfolio, it's designed to be very defensive. So it's a core defensive positioning of the portfolio. So it's a tough for that type of portfolio to beat the benchmark in a quarter where riskier credits did very well in the quarter. So that leads to some of the underperformance. So the lower quality CCC rated bonds that outperformed BBB and single B rated bonds in the quarter. It's actually the same story in bank loans. So the program, again, also had strong absolute performance, in aggregate about 3.5% for the quarter, but still slight underperformance versus the benchmark. Again, the benchmark had a very strong quarter in the first quarter of the year. And again, this portfolio is also constructed as core and defensive, and so it was difficult to beat that benchmark in the quarter. So high yield bank loans, kind of similar stories. ETI, again, similar story to the fourth quarter, had a strong performance in the quarter and beating the benchmark. And here it's a duration story as well. If you look at the duration of the ETI portfolio, here it's actually longer than the benchmark. So you would expect in that situation of lower yields in the quarter that the ETI portfolio would outperform, which is what it did. Moving on to hedge funds for police and fire. For the quarter, first of all, hedge funds did post a positive return, important to note. However, they did underperform the benchmark. And I would say that, given the construction of the hedge fund portfolio, which is a lower beta portfolio to the benchmark, it wasn't unexpected that we would have underperformance in the hedge fund portfolio, again, where you had a very strong equity market in Q1. And in the next few slides, I'll disaggregate that performance, the components of it. In this slide, you look at the performance of the hedge fund portfolio without the tactical trade. So again, here you see that the portfolio was positive, but did slightly underperform versus the benchmark. But if you look at the fiscal year to date and the longer periods, 3 years, you did have the portfolio is performing and outperforming the benchmark. Now, the tactical trade we reflect on this page. And again, as a reminder, the police and fire reduced their exposure by about 1% in the second quarter of 18 and invested that money in a tactical trade in hedge funds. So this is what we reflect as the tactical trade. And that trade yielded negative returns, as you can see, in the first quarter and underperformed the Russell 3000 and also in the fiscal year to date period. Again, that trade itself was a defensive trade moving out of equities. So you would expect, again, in the first quarter where stocks were up so strongly for the tactical trade itself to underperform. Now let's move on to the private markets, beginning with OFI. So here we're looking at since inception returns for the OFI portfolio through the first quarter of 19. OFI is still slightly trailing the public market equivalent, or the benchmark, which is the PME plus a 300 basis points illiquidity premium. Again, this portfolio is deliberately constructed to be low beta versus the market. So you have managers with idiosyncratic and company-specific exposures given the late credit cycle and expectations for some downside volatility. So again, in this quarter, managers with greater exposure to market beta were rewarded. So a portfolio like this did not beat the benchmark in the quarter. That being said, it did generate, as I mentioned earlier, a strong 3.5% total aggregate return. PE, and for the next few private asset classes, they're all reported on a lag. So this is now looking back to the fourth quarter. Just one thing to mention, of course, you remember the fourth quarter equity markets were meaningfully down, but the marks or certainly valuations in PE, and it's also real estate and infra, don't swing as wildly or in concert with the public equity markets, given how the underlying investments are marked. And by that I mean public market comparables are only one valuation metrics as to how private investments are valued by managers. So you don't see the exact swings that you would see in the market. So there was a little bit of kind of return compression in the quarter, but certainly nowhere near the 14+% that the markets were down in the fourth quarter. On this page, you have private equity, as I said, looking at kind of performance versus the benchmark, the public market equivalent. The portfolios continue to be slightly below the PME plus the 300 basis points illiquidity premium. Again, some of that anchored by some of the legacy investments in the portfolio, but the overall portfolio continues to perform strongly, which you can better see and appreciate on this next page, which you're familiar with. And what we do here is look at kind of the trends in the PE portfolio. As a reminder, on this chart, the y-axis measures the spread, the PME spread, either outperformance if it's positive, underperformance if it's negative, versus the public markets. And we look at pre-2011 performance versus post-2011 performance, that being designated as a time where we change the strategy together with your consultants on PE. And again, uniformly, pre-2011, we had meaningful general underperformance versus the public market equivalents in PE. And over the last 7-8+ years, very strong outperformance in private equity. Moving on to core real estate. Again, looking back at the fourth quarter of 18 performance, these are again since inception returns, and each system's core real estate portfolio is outperforming the PME benchmark. Once again, this is an asset class where we implemented a change in strategy, and since doing that, so since the GFC, since implementing a change in strategy, more rigorous underwriting, better manager selection, we've seen certainly a meaningful improvement in this portfolio. Just as a reminder, there's some differences in the systems, as you know, and that has to do with the pacing, different pacings, manager selection, certainly the commitment sizing and timing of these portfolios and how they were allocated. On the non-core real estate side, again, same story, strong performance overall. This portfolio has also benefited post-GFC from the changes to the investment strategy. So you're seeing the portfolio overall exceed its PME benchmarks. So very strong across the board. So we're very excited with the performance of the non-core real estate portfolio. Continues to do well. And again, as you've seen before, we disaggregate the since inception performance by vintage for the non-core real estate portfolio as pre-2011, post-2011, and you see that pre-2011, the portfolio was underperforming the public market equivalent, and post-change in strategy, as you see in the post-2011 bars, the portfolio has performed very strongly. And I would add that post-2011, all vintages are ranked either first or second quartile in the non-core real estate portfolio. And last but not least, we have the infrastructure portfolio through, again, the fourth quarter of 18. A couple of comments here. The infrastructure portfolio currently is about 46% funded. It's diversified across now 115 portfolio companies the systems are invested in. It is primarily North America and Europe is where the allocations are. And if you look at the sectors, I just want to point out that renewables are now 27% of the infrastructure portfolio. So that's how that portfolio is being allocated. This portfolio continues to do exceedingly well. As Petra would always say, it's still early, but nonetheless continues to show very, very strong results, and it's outperforming both the PME benchmark, which you see here, and the IPS benchmark, which is the CPI plus 400. And again, we also look at just performance by vintages, the mature vintages in infrastructure, and you see that all the vintages where capital has been deployed, 2015 has no bars because there was no 2015. You have no exposure to 2015 vintages. In other words, no investments in 2015. That all the other vintages where you do have exposure are doing well and performing very strongly, and that's driven by some early realizations in your portfolio, and certainly strong performance from your unrealized investments. So infra continues to perform very strongly. And that is a quick tour of the asset class performance for the quarter. Any questions?
Any questions for Alex? Thank you, Alex.
Sorry. Hi, good morning. For those I haven't spoken to before, Miles Draycott, I'm going to talk about a couple of risk issues. So the first thing I'm going to do is look at one page of the Blue Box reports. There are a couple things I want to call out, basically on what we refer to as the macro factor page. And then I want to use that as a segue to talk about sort of a work in progress for the risk group, which is return attribution. That's a sort of a separate implementation to the application that generates our risk reports. And then finally, I want to take a look at a couple of stress tests that we performed using the MSCI application, and are responsive to, I think, some of the concerns Mike has about the markets going forward. So this is the page of the Blue Box reports I referred to. This is the macro factor page. And there's basically...
Miles, I'm sorry to interrupt. The Blue Box reports are the quarterly risk reports that we're now providing
Correct.
to the...
Correct. Absolutely. Probably should have clarified that. So anyway, last time I spoke to you at a quarterly sim, I mentioned that we had added this page, which is the least granular of the risk reports, in the sense that it just looks at the 6 what are called macro factors. Anyway, the issues that I wanted to call out on this page are really twofold. The first is, if you look at the arrow in the middle, I'm pointing to the ex-ante volatility of the portfolio at the quarter end. So I just wanted to note, which is something of a statement of the obvious, volatility has gone up pretty markedly. The ex-ante volatility at the end of March was 772. That's compared to 667 at the end of December. If you go back to the end of September, at which point we didn't have the private assets in the risk system, but we did have all of the public market assets, it was 629. So volatility has gone pretty much straight up over the 3 quarters we've been talking to you about risk reports.
I'm sorry to interrupt.
Sure.
I'm over here.
Oh, sorry.
This way.
Oh, I'm sorry. Okay.
Introduce yourself, Terrell.
Terrell Brown from the fire department. Can you just speak up a little louder, because you're competing with the air conditioner back
Oh,
there?
okay. Certainly, and I'll look down that side of the room occasionally. So the things I'm trying to call out on this page are one, the fact the central arrow there, the middle arrow, and the text to the left is just observing that volatility has marched straight up. It's currently 772. It's up from 667 at the end of last year, and then in September was down at 6.29. So just we all know volatility's gone up. That's a rough indication of how much it's gone up. The other thing I wanted to draw attention to on this slide is up at the top left, where the bar charts are. I'm calling out one set of exposures. That's to the interest rate factor. So here we're looking at a system that's where the difference between the duration of the benchmark relative to the duration of its portfolio is quite high, and that differential is the red bar that's sort of pointing south in that red box that I'm calling out. And the magnitude of that differential is 0.22. And in the bottom arrow, I'm actually calling out where the magnitude of that red arrow is identified. So in the chart at the bottom, you'll see that the bottom arrow is pointing out negative 0.22. That's the magnitude of that differential between the interest rate sensitivity of the portfolio versus the benchmark. So the other thing I wanted to draw out is that has declined quite markedly for this system over the quarter. It was negative 0.71, so it's been reduced by about 2/3 over the quarter. This is confirming what Mike said, which is that the rebalancing committee made a conscious decision to extend the duration of this system's portfolio over the course of the quarter. So with that, I want to kind of segue into a work in progress, which is return attribution. So the format, going forward, we are going to supplement the blue box reports with reports detailing return attribution. They won't. The exact format of those reports is still a work in progress. What we're going to go through is some of the content that we would expect to include in those reports when we start adding them to your quarterly reporting package. So here, continuing to look at the same system, we see the asset allocation between public debt and public equity detailed in the little pie chart in the center there. We need to observe I want to observe in this case the underperformance. There was actually a 19 basis point underperformance of the public markets portfolio relative to its policy benchmark. Okay, that 19 basis points of underperformance came about as a result of actually outperformance in the case of the public equity portfolio, but it was offset by a larger underperformance by the fixed income portfolio. So in this case, the public equity portfolio actually outperformed its benchmark by 22 basis points. The total return was 1305 versus a benchmark return of 1284. So did well in equities there, but this same system really undershot the benchmark in fixed income, where the total total return was 279. Sorry, there's some rounding errors here in terms of the calculation of the excess return. But it was basically about 100 basis points negative active return. So we're going to dive into that in a little bit more detail as to what contributed to that here. Now you see this is the public equity portion of the portfolio. The pie chart on the left actually details the allocation by sector of public equity in this system. And then what we do on the right is we attribute the returns, both returns. The absolute return is described by the bar charts on the top. So if you sum those, you will see, if you sum the numbers above each bar, you will get the 1305 total return. The charts on the bottom, we break out the same thing for active return. If you were to sum the numbers above each of the bars on the bottom chart on the right, bottom bar chart on the right, you would get the 22 basis points of positive active return. And the other thing that you'll note here is that there were tilts towards IT, finance, and healthcare in this system's equity portfolio, and those paid off sort of handsomely relative to the small underweight in industrials and the categories that have been combined under other on the far right. So the other thing to note about the performance in the case of this system was that although allocation contributed handsomely to the outperformance, security selection played a very major role, in fact, a larger role. So the managers did a good job, and the active managers did a good job in terms of security selection. Turning to fixed income, again, we have a pie chart on the left which kind of describes the asset allocation by sector of the fixed income portfolio. And then, again, on the right-hand side, we see the attribution to both total return and to active return. So if you were to sum the bars on the right, to repeat going through it in painful detail, you get 2.79. That was the absolute return of the fixed income portfolio. And if you were to sum the bar charts on the bottom, you would sum to the negative 99 basis points, call it 100 basis points of negative active return. And you would note that the largest portion of that active return came from two sectors: government, which is U.S. Treasuries, and agencies, which are agency-backed mortgages. And it's probably worth noting that those are the two sectors within fixed income where this particular system had the largest mismatch between its benchmark duration and the duration of the actual portfolio. So this final slide is very much, sorry, the axes have not come out on the bottom chart. But what this is a distribution. The top bucket, the top bar chart, is a distribution of that system's active duration mismatch. So if you were to look at the duration of the portfolio and to break it out by maturity, and you were to look at the duration of the benchmark and break that out by maturity and look at the differences by maturity, you would see the bucketed active duration, which is described in the top bar chart. This whole page is about how you attribute changes in the value of fixed income portfolio to changes in interest rates. So the middle chart is actually between the beginning of the quarter and the end of the quarter, the change in interest rates. If you multiply the two together, you get the total change in value of this system's. In this case, this is a Treasury portfolio. So this information is quite important. When we present it in future, I'm going to do kind of a worked example in tabular form, so you can see that it ties out with the information on the previous page. Again, the final attribution here in terms of fixed income performance is between selection and allocation. So in the case of fixed income, allocation is between fixed income sectors. So there was, not an identity between the allocation of the benchmark and our portfolio, but it didn't contribute nearly as much to performance as selection. So we own treasuries and agencies, what that's telling you, but we don't own, as in aggregate, those securities that have the duration of the benchmark. All right. So I wanted to finally move on, and I want to move on and finally talk about the stress test that Mike mentioned and I alluded to at the beginning. So we wanted to look at three of the scenarios that Mike touched on as being possible evolutions over the next couple months. The first, which Mike referred to as the insurance cut, is the thought here is maybe the Fed has come to the conclusion that it raised rates too quickly or by too much, and it wants to basically it's asking it may perform a redo in the hope of keeping the economy growth in the economy moving as it has over the last couple of years. So in this scenario, we see the portfolio actually increasing in value by 6.8%, and we'll go into how that breaks out by asset class and what the assumptions behind that are. The middle scenario is where we have a impending recession, or it seems like growth is slowing. The Fed responds, cuts rates. We're seeing this slowing of growth in the U.S. happen coincidentally with a slowing of growth overseas. In this instance, we see the portfolio dropping in value by almost 4%. And then finally, we have the scenario which Mike referred to as regime change. What he's talking about there is regime change in terms of the Fed's policy. Not that it steps away from targeting inflation, but it's a little less dogmatic about trying to nail 2% exactly, and the idea is it might allow inflation to periodically exceed 2% by a small amount before it takes action. So this is kind of announced by the Fed, taken seriously, and the response of the market will be perhaps the portfolio will gain in value by about 1.5 points. And this is, given those scenarios and the assumptions behind them, we've broken it out by asset class. And then finally, we actually go into, these are the assumptions that went into constructing each stress test. These were arrived at in conversation both with Mike and a fellow at MSCI that came to talk to many of the trustees about risk budgeting. Sorry, so that's it for today.
Questions?
I just had one question. When you talked about the easing, the insurance easing, and that could have an impact on the portfolio of 6.8%. I had a question because Mike seemed to say that the markets are already priced in anticipation of easings going down this year, perhaps as far as into 2020. So I kind of wanted to see how those two things fit together.
Yeah, so when I make that statement, it's what short interest rates have priced into them. So that's based upon Fed funds futures. That doesn't necessarily mean everything, all assets have that priced into it, although if one believes in efficient market hypothesis, you would follow that thought. But if the Fed doesn't deliver, then interest rates go back up, and logically equity markets would sell back off. So maybe in your specific question, the Fed needs to ratify what's there, and that would hold those gains. I don't proclaim to know the answer to that. It's a timing issue.
Yeah, I mean, this is all subject to the assumptions, and will the market actually move when, or has it already moved? It's market psychology.
Other questions for Miles? I take that to mean that everybody understands 100% of what Miles just went through. So there'll be a quiz at lunchtime. No, I have a question because I do not.
Can I volunteer one thing first, John? I mean,
yes.
To that end, if there are any questions about anything I've gone through, we welcome interaction and dialogue. And I also wanted to emphasize that return attribution reporting is a work in progress, and the format of that, to some extent, it can be a function of input we receive from you. What would be of interest?
Okay. Miles, my question is about a slide, 3 or 4 slides earlier, where the x-axis is identified as the key rate. that one, go back, that one.
Yeah, this is
key
the
rate.
one which, again, I apologize because the axis isn't even, there's not even any numbers on the bottom axis.
But what's the key rate?
Oh, it's just that again, this is the key rate duration. It's a way of bucketing the duration, the overall duration of the portfolio into maturity buckets. That's all that's meant by that. And there's a long discussion we can have about how you bucket duration into maturity buckets.
But you won't have that today.
But we
that.
probably aren't going to do that today. But I'm happy to get into that with at any point.
I'll look forward to that. Thank you.
You would enjoy it, actually.
Oh, I'm sure. Any other questions for Miles? Okay, thank you, Miles. Alex, is that it for performance reporting?
Yes, it is.
Okay, any questions for any of the presenters before we exit this section? Okay. So with that, I believe that concludes our public agenda for this morning. So we're going to entertain motions to enter executive session. But first, I just want to note for the record trustees that may have arrived since roll call. Veronica?
Veronica Avis for Public Advocate Jimani D. Williams.
Thank you. I think, yeah, Jack.
Jack Kelty, fire.
Anybody else? Yeah, go ahead.
Susanna Vickers at Teachers.
Okay, thank you. Okay, so now we're going to entertain motions. We'll take it in the opposite order. Is there a motion from NYSERS to enter executive session?
So moved.
Thank you, Mr. Katzman. Is there a second?
Second.
Oh, thank you, Mr. Jeter. Is there any discussion? All in favor of the motion to exit public session and enter executive session at NYSERS, please say aye. Aye. All opposed, please say nay. Any abstentions? Motion carries. Teachers, is there a motion to enter executive session?
So moved.
Thank you, Mr. Kazansky. Is there a second?
Second.
Couldn't see who that was. Oh, Ms. Penny, thank you. Any discussion? All in favor of the motion at teachers to exit public session, enter executive session, please say aye. Aye. All opposed, please say nay. Any abstentions? Motion carries. Police, is there a motion to enter executive session?
Motion to go into executive session.
Thank you, Officer Alejandro. Is there a second?
Second.
Thank you, Mr. Dorsa. Any discussion? All in favor of the motion to exit public session, enter executive session at police, please say aye. Ooh, what enthusiasm. Any opposed? Please say nay. Abstentions? Motion carries at police. And at fire, is there a motion to enter executive session?
Motion to enter executive session.
Thank you, Mr. Brown. Is there a second? Thank you, Mr. Kelly. Any discussion? All in favor of the motion at fire to exit public session, enter executive session, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Motion carries. So we are now in executive session at all the systems. Can we please turn the cameras off and ask any members of the public and the media to exit the room?
In executive session, we received information on certain policy and program issues. Consensus was reached, and policy and program issues and exceptions. Consensus was reached when appropriate. We also received a review of TRS-specific returns. We received presentations on 2 private equity managers. Consensus was reached on 1. We received presentations from several emerging market managers. Consensus was reached, which will be announced at the appropriate time. Consensus was reached on terminating 2 emerging market managers. Consensus was also reached to add several emerging market managers to a pool for future use. Thank you.
Any other business before the board today? Seeing none, a motion to adjourn?
So moved.
Second?
Second.
We're adjourned.
So during the executive session, the board discussed various investment matters. We now need a motion to adjourn.
Motion to adjourn.
Second. Thank you.
Thank you.